Hello, and welcome to Ipsy Dixit, a podcast on legal scholarship. I'm your host, Luce Nguyen, a college student and co-founder of the Oberlin Policy Research Institute, an undergraduate public policy research organization based at Oberlin College. My guest today is Nizan Packin, assistant professor of law at Baruch College, Zicklin School of Business, and affiliated faculty member of Indiana University Bloomington Program on Governance of the Internet and Cybersecurity. We will discuss her article, RegTech, Compliance, and Technology Judgment Rule, published in the Chicago-Kent Law Review. Welcome, Professor Packin.
Hi, thanks for having me.
So let's go over why did you write this paper and what's the main crux of your argument within this paper?
So in recent years, there has been a lot of attention focused on regulatory technology, which essentially is a subcategory of regulatory compliance. And what it means is for companies or corporations or institutions to not just comply with rules or with standards of law or certain types of policies, but to do so with the use of technology. And I felt like technology was extremely helpful and RegTech was getting a lot of attention, but I wanted to point out that while it has a lot of benefits, it has certain weaknesses, and we should all be aware of those and kind of try to make the best out of RegTech while acknowledging what is less efficient or useful in that technology.
So what particularly is RegTech and what does it look like?
So in the field of financial technology companies, we basically have two types of institutions or businesses operating. The first category is the one we more typically think of when we think about fintech companies, and that's more the disruptors, the companies that are innovating and are creating new financial service technologies and features, and that's the first category. The second category is more of a facilitators type of companies that help with the upkeep or the maintenance of certain infrastructures or technologies, operating within that space of financial services, increasing efficiency and helping with monitoring and data analytics. And that's more where you find the regulatory technology companies operate in that second category. And so what they basically help do in our very technology-driven era is manage regulatory compliance issues or matters by basically helping companies that need to comply with the law achieve their efforts by using all sorts of new innovative technologies and digital tools.
So what particularly is the landscape which companies are using RegTech to what's the legislative landscape that companies might seek to use RegTech to enhance compliance?
So it is a very broad spectrum. So basically companies, whether they're the more disruptors or just more traditional types of financial service providers, use RegTech facilitators or RegTech companies to do all sorts of things, whether it's to automate corporate governance and compliance processes, whether it's to improve their risk management, whether it is to internally get more efficient results, whether it's to automate services that they offer, such as robo-advising or wealth management types of services. It could be to keep them up to date with the latest regulatory changes. They could just implement all sorts of automated services to minimize the likelihood of human errors, increase overall governance processes, or just basically use new or more efficient cybersecurity tools, or management features. So a lot of different options. Recently, banks have even used RegTech technology as they figure out their capital allocation for their stress tests in order to sort of maximize their profits while still obviously staying within the boundaries of compliance with the law. So a lot of different things that the RegTech tools have been helping companies, improve and sort of help solve industry needs in.
So within the financial industry, there is fintech. Can you tell me about what fintech is and how it developed?
So the first type that I was referring to before, the more hardcore, type of fintech companies, the ones we kind of think about when we think about fintech, are the disruptors. And as I mentioned, those are companies that basically innovate in terms of the financial services that they offer, and they're the more disruptors type of businesses that we see operate in financial services. And many of them are essentially their goal is to offer financial services without being a bank. So the fact that they're non-banks essentially means that they're institutions or companies that provide any type of banking services, but they're not a bank. So they do not have the legal status of a bank, or they do not have the full banking license. And what these companies do is they pretty much offer everything and anything that you would think is a financial service that traditionally or historically a bank could have offered. So it could be facilitating payments, or giving credit. So we see a lot of alternative credit providers. It could be in all sorts of loans. It could be innovation in terms of wealth management or financial advising. Again, going back to the robo-advisor type of businesses like Betterment, or all the new other companies that have been offering these types of services after the financial crisis since 2008. And there are a lot of different types of, it could be cryptocurrencies or all sorts of other blockchain-based financial services. And we see, these fintech companies, these non-bank, financial service providers offering services all over the world. So obviously not just in the US, but a lot of times international services as well, all over the world.
So how are these non-bank financial companies regulated, and how should they be regulated?
So that's the $1 million question that people have been talking about in the recent decade or so. And the main issue to keep in mind is really that the reason they're non-banks is that they wanted to avoid having the legal status of a bank, which means all the regulatory requirements that come along with that status. And so obviously they are regulated because to some extent in various ways, which I'll mention in a couple of seconds. But the main thing is that they're not regulated like banks, and so it is an advantage in certain ways, but obviously can pose certain types of risks, and those should be kept in mind. And so we see that different countries around the world have tried to kind of figure out different ways to regulate or monitor the business that financial technology companies are offering. So in many countries, we have initiatives that enable them to kind of experiment. Those are referred to the sandboxes, where the regulators are working with them to kind of try and help them innovate while also monitoring and making sure that consumer protection and prudential regulation goals are kept. We also see a lot of, in the US, state by state regulation, depending on the type of financial service that they're offering. There are certain, federal, nationwide laws that require financial technology companies to comply with, such as, issues relating to the equal and fairness grant of credit and loans, and certain initiatives are being proposed now, certainly in states, but also being discussed in the federal level about cybersecurity. And so while they're not regulated as banks, there are all sorts of regulations and initiatives to for the regulator monitor these financial technology service providers.
So can you dive in a little more into what the particular goals of financial regulation within this sector are, what the particular incentives that regulators and legislators want to put on these companies looks like?
Sure. So in terms of financial regulation, there are really, two main big goals that we're, kind of concerned about and want to make sure we are protecting. And the first is consumer protection. The second one is the safety of the entire system, the systemic risk and prudential regulation. And so in terms of consumer protection, we want to make sure that, and that's certainly a risk in the context of the financial technology service providers as well. We want to make sure that consumers are protected. There is a lot of asymmetry in terms of what the average person knows or has access to in terms of data. And part of the consumer protection regulation is meant to overcome this, asymmetry, this informational asymmetry. And so we want to make sure that investors are protected and that consumers' rights are protected, and that consumers' funds are protected to a certain extent at least, and that they're aware of certain risks and what the possibilities might be when they engage or do business with alternative or new financial service providers or disruptors. So that's one thing. And then the second thing that we need to be aware of is obviously the safety and the soundness of the entire system. And so while in the first few years the magnitude of the financial technology service providers was smaller, as this becomes a bigger part of the financial service pie, these non-banks and their activity, we want to make sure that the system itself is still safe and protect the soundness. And so we want to make sure that there is no new systemic risk, and that the aggregated financial activity is monitored and in a desired good condition, so to speak.
So how do regulatory technologies help achieve these policy and legislative goals?
So RegTech is very helpful, not just for the companies themselves, the private sector companies that are using the different tools and features to solve industry needs in a more effective and efficient ways. They're also helping the regulators, because we live in a very information and data based era. And so what this means is that the regulators themselves are also swamped with information and need to act in a more efficient and cost-effective way as they analyze and monitor and ensure correct compliance. And so the advantages are not just for the corporate governance or the risk management private sector side of things, but also to help regulators better manage the increased volume of information and make sure that they're monitoring and evaluating everything they see more efficiently. So it is very helpful for them. So regulators use some of the very same tools to increase their efficiency. They automate processes as well, and they run data analytics and examine the information and have more access to information and can interpret results better.
And what are the particular negatives and hindrances that financial technologies can pose to these policy and legislative goals?
So as I mentioned, obviously RegTech has a lot of advantages, and it could be a great tool and very efficient as well. However, there are certain things that I don't know if they're disadvantages, but certainly things that we need to keep in mind and figure out better ways to address these difficulties or challenges. And those include, first, the fact that RegTech tools cannot on their own eliminate undesired or unethical business practices. So if we are aware of certain undesired or unethical business practices in the financial sector, in the financial industry, we cannot rely on technology itself to be used to sort of address or eliminate those issues. And furthermore, actually, technology can even be used to better evade certain regulatory requirements. And this is a thing some people refer to as anti-reg, because once you, as the private sector company, use technology to reach the most efficient results to maximize your profit, you might be on the very, very edge of almost evading the regulatory requirements, or almost not complying. So just complying, just passing the very bare minimum requirements. So that is something to keep in mind. Another thing is that technology can obviously hinder good judgment and human input in risk management, because in recent years there has been a lot of discussion about how technology, and in particular RegTech algorithms and tools, are in some ways black boxes that we don't fully understand and cannot fully control. Certainly, if we're talking about machine learning algorithms and sophisticated programming that constantly improves and evolves and tries to reach more effective, efficient results. And so this is something that we need to be mindful of as well. Another thing is that RegTech tools are often used via third parties, and that introduces new risks. So partnering with third-party vendors is something that is very useful in many ways, but those third parties might not be familiar with the same level of risks and dangers. And if much of the work and risks are outsourced to these third parties at the end of the day, then the financial service companies are not dealing with it directly, and that is something that can cause more or different types of risk. And another thing is that initially people were very excited about RegTech tools lowering costs, and because of the automation, making things more financially efficient, and that is not necessarily the case, because as automation and efficiency gains were in fact present, at the same time they're offset by the rising regulatory requirements, costs, which are the result of the regulators also using these tools and want more and can demand more data or interpretation or results, because they are also aware of these very same tools. And last but not least, there are certain barriers that are relevant mentioning when we discuss RegTech adoption. Obviously, in order to adopt proper RegTech tools, you need more money, you need access to data, you need talent, manpower, and human resources are working very hard to recruit the best, most talented individuals. And so it's not obvious that everyone and anyone can easily overcome these barriers as they adopt the RegTech tools.
Can you talk a little more about the particular barriers that exist towards the implementation and adoption of these technologies?
So again, it's really many of these issues that we need to find the best people, and that's not so easy to do. And in order to get that talented manpower and these people, you need to obviously pay them higher salaries, and you need to get that talent. And in addition, RegTech includes financial resources. You need to invest a lot of money in these systems, which are cutting edge and new. And in addition, you need the data and you need the information, and you need to be able to work with it, and get that access is not always that easy as well. And so that's another hurdle. If you don't have that information, you can't process or do or achieve certain goals that you might want to achieve.
So you talked a little bit earlier about anti-reg tech. What particular role does corporate cultures that seek to evade or go right up to the line of these regulations play into the challenges that reg tech faces today?
So basically, technology can be used for good, and that's our hope. But it can also be used by businesses to sort of avoid or frustrate regulators' intentions, and that's what I meant. That's the phenomenon that I referred to as the anti-reg tech. And so, for example, I mentioned earlier, one recent example could be that banks that are seeking to automate the calculation of the precise capital allocation they're required to have in order to pass government stress tests. So obviously, these banks want to pass these stress tests while maximizing their returns. And in some respects, that it could be a little bit concerning because the banks are under pressure to manage their capital and liquidity more effectively, and they definitely don't want to hold additional capital if they can determine via RegTech tools what the exact minimum required capital level or magic number should be, because that would impact their profitability and net margins. But as we know, to be one of the 2008 crisis lessons is that we need to be extra careful with these things, and the Federal Reserve constantly checks and carefully assesses what the biggest banks, where the biggest banks need to be in terms of operating, and in order to avoid finding themselves in the riskier zone. And so, while obviously RegTech tools are great, if used incorrectly to reach the most efficient profit maximizing point, it could also almost frustrate the purposes of the regulators to find if they are meeting the stress test requirements and to make sure that the system is in a relatively good state, and so this is something that we need to be mindful of. Obviously, magic numbers are great, but sometimes it's not as easy as hitting the one number that an algorithm spit out, and that is an absolute answer, because we know algorithms are not science. There is no one magic formula. 2 plus 2 doesn't always equal 4 when you look at different algorithms. Well, in reality, 2 plus 2 is always 4. So it's hard because you want to use technology to do good things, but you need to be mindful of the fact that we don't want to use it to almost frustrate regulatory goals.
And in your opinion, why does all of this matter?
So obviously, in our world today, we're relying more and more on algorithms and technology. We outsource more and more to technology, even passively outsource at times. We sort of, would rather have an automated decision-making process deal with that decision for us, and it's easier to automate, and obviously sometimes cheaper and more efficient. Usually cheaper and more efficient. And so, RegTech has a crucial role in our technology-driven era. But while we can definitely benefit from it, and it's one of the only answers to the risks and challenges that we currently have in our financial industry, I think that we need to be aware of the risks and carefully design our technology and our reliance on technology. And we need to figure out ways for the regulators and the private sector to use it efficiently, but also not blindly rely on it and assume that it's the answer to all corporate governance challenges. It can solve many challenges and address many issues, but it can't solve everything.
And as a final question, what do you think that companies, regulators, and policymakers should be taking away from your paper?
So I think exactly that we need certain shifts in corporate thinking to acknowledge that we just simply cannot blindly outsource all government all governance and risk management issues to technology. We still need to think about these issues. RegTech or technology in general is not the all-end solution to corporate governance issues, risk management matters. We need to still think about these issues. We need to be aware of the potential risks and try to constantly improve and make our processes more efficient.
All right. Well, thank you very much, Professor Packin, for coming on the podcast to talk about your work.
Thank you for having me again, and it's been a pleasure.
The circle, like the network, will kindly pull itself together. Carey?
Present.
You were instructed last week to find out the whole truth about those bells. Have you done so?
I have.
Out with it then, Beetle.
Well, okay, Ronnie. Now look, the bell notes serve as a cue to operators all over the country to switch circuits in order that local stations can give out their call letters, you see? And that has to be done because of regulations for the public good, made and enforced by the Federal Communications Commission. I have a copy of that regulation right here, Mr. President.
Well, let's hear it, Carey. I think we ought to get to the bottom of this thing.
Okay, Bobby? Each licensee of a broadcast station shall announce the call letters and location as frequently as practicable during hours of operation, and in any event before or after each program being broadcast. In no event shall more than 30 minutes elapse between such announcements, and insofar as practicable, these announcements shall be made on the hour and half hour. These requirements are waived when such announcements would interrupt a single consecutive speech, play, symphony concert, or operatic production of longer duration than 30 minutes. And in such cases, the announcement of the call letters and locations shall be made as soon as possible.
Now I know why they ring those bells.